Let's look at long-term opportunities in overstretched markets. Tons of videos are out at the moment talking about lofty stock valuations, and hours of your time could be taken up by videos with thumbnails like these, which are often speculative, talk like they've got a crystal ball, and usually miss the point that no one knows when the crash is going to happen. And most importantly, none of these videos help you with your investment decisions right now. And I'm sure we're all really bored of being shown these overly complex charts that don't really mean anything. So today let's change that. This video very quickly accepts where the stock market's at, but then afterwards we're going to focus instead on an opportunity that's presented to everyone, no matter if they're a new investor or a seasoned retail veteran. As a disclaimer, I'm a retail investor just like any other. Anything in this video and on any of my other content exists purely for educational purposes. Anything seen as a recommendation for whatever reason should be considered just my opinion. Always conduct your own research for the investment choices that you are going to make that are ultimately your responsibility. That one day the stock market's going to crash is all we need to say on the matter. If we're young and long-term investors, then there's nothing else that needs to be done. What most importantly matters right now is what we can do to continue to diversify and invest. Assuming that we're going to continue investing at frequent intervals throughout our times as investors, then the smartest thing to do right now is to question, when the market is so overvalued, where should I be looking to put my money next? That's not a preparing for when the crash happens, it's what do I do now? The answer is that it's going to be something undervalued with excellent long-term potential. But how do we exactly know what has long-term potential in this scenario? Probably the best way that we could answer this is that it's something that by the time you die, you'd hope that humanity is either perfected or got much closer to perfecting. Something that's going to be a constant challenge throughout our lives. We could call these no-brainers, and they generally refer to a market or sector. They don't refer to specific companies, and that's because of the long-term time horizon associated with them. 9 times out of 10, they'll be represented by an ETF, because the purpose of these no-brainers is that they should not require much thinking about. Hence, an ETF is the perfect vehicle to take advantage of them. We could call them set-and-forget investments. When the market is broadly oversaturated, an undervalued set-and-forget investment might be one of the best things that you can do to ensure that your capital continues appreciating in the long run. There might be many such investments right now, but the one we will look at for the rest of this video is clean energy. We'll look at the long-run strategic rationale for considering this market, and then we'll look at the short-run tactical factors to see if there's a compelling case right now for diversifying via this market. As another disclaimer, I do hold a position in the iShares Global Clean Energy ETF, so as always, do your own research and consult a range of sources before making your investment decisions. The long-run rationale for investing in clean energy is the simple thesis that energy will get more sustainable as time goes on due to innovation. The thesis is backed by some practical realities. Whatever way we cut it, as time has progressed, energy efficiency has increased, which loans itself to sustainability. Secondly, regardless of when this happens, it is a fact that at some point fossil fuels will run out, and as a result humanity will need to be producing its own sustainable energy. Both of these factors imply future realities where clean energy is definitely incentivized. The scarcity issue necessitates that energy markets will innovate, and it is there that clean energy stands to benefit. So, cleaner energy is a time-related reality, and therefore the green clean energy transition will happen one way or another. It may not be a linear path towards clean energy. There will definitely be cycles of increased interest, and then decreased interest. It's your classic boom and bust cycle, which we'll come back to in a moment. But first, what needs to be addressed is the glaring counterpoint to investment vehicles like this. And that's that many of the companies in an ETF that looks at clean energy are not going to be replacing the behemoths of today's energy market anytime soon. Let's assume this is true, and if it is, and you're 100% certain of this, then the entirety of the ETF shouldn't exist, and you might as well short the whole thing because it has no value. Of course, that would be silly. Even if these companies don't replace Shell, BP, or Exxon, it should be argued and agreed that these companies will nevertheless occupy critical roles in the overall ecosystem and its supply chains. As we've seen, once tiny chip manufacturers can go very far right now, even if their components on their own have little to do with the overall system. To illustrate, let's have a look at some of the things that the companies in this ETF are doing. First Solar dominates utility-scale solar manufacturing in the US. It boasts a significant domestic manufacturing capacity too. Demand is clearly visible for this company, demonstrated by a 54.5 gigawatt and $21.7 billion backlog in orders. It's very likely to sit comfortably with its business model so long as it continues fulfilling these orders. And then you've got companies like Nextracker, who specialize in solar tracking technology to optimize energy capture and increase solar panel efficiency by up to 40%, thereby increasing other companies' competitiveness. By supplying components essential to energy producers, it's less vulnerable to market structure criticisms, and as demand for solar grows, component suppliers like Nextracker may profit broadly regardless of the energy producers that are involved. And then our last example today is Enphase Energy, whose microinverters represent an innovation that improves efficiency and safety. At the same time, the global microinverter market is set to grow more than 3 times over in the next 10 years, and Enphase controls over 40% of the US residential market right now. These factors prime it to be a beneficiary company as broader market trends change and adoption expands. The examples that we've just looked at are more complementary rather than revolutionary market participants. Sure, as we go through the ETF, we see that some are not as complementary and do try and pursue a business model way more reliant on total transition. Yeah, that's risky, but not every constituent needs to be a success. That's the point of an ETF's diversification. And at the end of the day, it's a compelling argument that if renewables will supply nearly half of global electricity by the end of the decade, then the companies providing enabling technologies, like these ones, will benefit. As they say, when there's a gold rush, sell shovels. But why is this ETF on my radar right now? Well, between the start of the year and the beginning of the month, the iShares Global Clean Energy Transition ETF shot up by over 45%, beating not just the S&P 500, but also the trackers tracking Nasdaq companies. That's significant. It represents the start of a long-run trend reversal and a return to medium upside potential for the iShares Clean Energy ETF. You see, clean energy companies have likely been oversold for some time now because of 2 main factors revolving around macroeconomic cycles and the war in Ukraine. On the surface of it, it's not exactly obvious that this is the case, but you can see that following the war in Ukraine, when energy prices rose driven by a restriction in the supply of fossil fuels, the world did realize that at least for now, we are reliant on those fossil fuels and clean energy is not going to be a sure fix right now. What followed were then higher interest rates as global inflation took hold, and so as a result, less immediately certain investments were deprioritized. Clean energy was unfortunately one of the victims here, something made worse as a global shift against ESG impacted investor sentiment. As a result, after 22, clean energy collapsed following a 36% rally, and what followed was a rough few years for clean energy stocks. Now, however, it looks like the capital is coming back in. The cycle of boom and bust is perhaps nearing the end of bust and leaning back towards boom again. As interest rates continue to fall slowly but surely, and some policy decisions in the US, like the 5% safe harbor rule for small solar projects, take place, investors are feeling perhaps that maybe clean energy has been injected with a shot of optimism. The ironic part is that this depression in clean energy probably shouldn't have happened in a perfect market. In the 1970s, it was precisely energy-related inflation from the Arab-Israeli war that led to some of the most seminal thinking in clean energy products. The aforementioned reliance on fossil fuels is precisely the vindication for these companies and this ETF. With all that in mind, while all the noise is now descending on AI and the tech bubble, you could do worse than considering a clean energy ETF to get into a no-brainer market at a comparatively good time. If or when the AI bubble pops, I'm sure that this ETF will be affected in the short run by overall market sentiment. We've seen exactly that in just the last week. But that doesn't negate the fact that the long-run fundamentals in favor of this thematic ETF remain the same. Right now, as investors come to terms with the decreasing upside potential in tech stocks for the short to medium term, it's very clear that a growing set of investors are once again looking to this promising but inevitable trend in energy.